All right, learning objective 4, projecting financial statements. And what we're going to do here is use Excel to show an example of how you could go through the steps of determining your balance sheet and your income statement and cash flow based on some assumptions. First, we're going to say, what is the sales growth rate? Of course, we've already talked about the difficulty of getting it, but let's say you have it. Next, we're going to look at some key ratios based on historical relationships. An example would be cost of goods sold percent, which is COGS divided by sales. Third, we're going to adjust the ratios to see if you believe from a forecasting standpoint that's going to go up or down. Next, we'll go through and analyze which items are fixed and know that these will not change. So just because you got a relationship of rent as a percent of sales, it doesn't mean that if your sales go up, your rent goes up, right? So use a little judgment to look at the line items that you are forecasting. Fifth, some of the accounts are based on some other results. Perfect example is income tax. So that's not a growth rate as a percent of sales. It's really derived from pre-tax income and the income taxes. So let's jump into the financial statements and projections sequence. First, income statement. Second, balance sheet. Third, cash flow. And right, so this slide in PowerPoint is a placeholder because we're going to do our work in Excel. So I'm going to hop out right now to Excel. All right, so this mirrors the sequence that we saw in the PowerPoint, and it represents the steps, right? Step 1 being income statement. The colors have some significance here. The left column are actuals in kind of light yellow. So we just capture those for the income statement from sales down to net income. And also, you'll note that we're getting to retention rates, so we have dividend rates as well. Next, we do the ratios, just stating everything as a percent of sales. This is a very simple Excel exercise to state everything in percent of sales terms. Easy one. Next, in blue are our assumptions, the most critical of which is this one. What is our sales growth of 30%? Notice that all the other ones here are the same, with the exception of the income tax, right, which we just mentioned. But the 40, 10, 3, 17 are all based on what we saw before. And also, we have the dividends we're assuming remain at 0. All right, let's look at the projected columns and go through each cell to make sure you know how to do it. The first cell is the key one, of course, sales. This equals last year's sales times the projected growth rate, 1.3, and 1.3 times 1,006,000 is 2,080. This is important because we're going to state most of the expense assumptions as a percent of sales. For example, cost of goods sold. We estimated that this year will be the same as last year, 60%. So 60% of 2,080 is 1,248. That's our cost of goods sold. Next is a subtotal. We take revenues minus cost of goods sold, and that represents the gross profit. Next is marketing expense. We see here that we're expressing it as 10% of sales. So sales times 10%. Next is G&A. We assume that this is fixed. So fixed does not change. So it was 152 last year, 152 this year. Next is depreciation. We're going to start by stating it as a percent of sales as a rough cut, but as note A states that we could refine it by estimating it as a percent of gross property, plant, equipment, or gross fixed assets. But for now, let's do the simple way and express depreciation as a percent of sales, just for our first pass. Next is our operating expense, which is a sum command of the lines above. Next is EBIT, which is the gross profit minus operating expense. Next is interest expense. Here we assume, again, see note B, that there's no change, even though that's a little naive because we may likely borrow more money. But again, first pass, let's get all the way to the end and then go back through and refine the assumptions. So here we take a simplistic view, assume it's the same as last year. Next, we get to earnings before taxes, which is the operating or EBIT minus interest. Next, we do income tax, which here we're given is 40%. So 40% of 386 is 158. Next is net income. Net income is pre-tax minus tax. And you got it, right? So now we have a projected income statement. The bottom is, as mentioned earlier, related to change in retained earnings, which adds the element of dividends. But we had 0 last year, we had 0 projected for next year, so it's 0 here. It's on the spreadsheet as a matter of form, so if you want to use this later on, it's there to remind you to look at dividend policy. So that is step 1. So next we're going to go to step 2, which is forecasting the balance sheet. Similar idea, we have 2016. These are actuals. This is stated as a percent of sales, again, not percent of assets, and it gives us a rough cut at forecasting a balance sheet. Here, let's go through it again. 2017, cash. What is cash? It is 1% of sales up here, 2080. So 1% of sales is to 20,800. Next is AR, again, stated as a percent of sales, 11.5%. The note here is you could do refinement if you had time, or you would do the next pass by using an accounts receivable measure such as day sales and receivables or turnover rate of receivables. But for now, simple first pass, percent of sales. Next, inventories. Again, we stated as a percent of sales, 20%. But note E is you could do refinement based on your projection for what the inventory turnover will be for next year, based on last year or perhaps more history. But again, first pass, easy, sales. The total current assets is just a subtotal of the above, cash plus AR plus inventory. Next, we're forecasting PP&E. Guess what? We're forecasting as a percent of sales. We may again want to forecast a more refined way of getting PP&E turnover, but first pass, sales. See a pattern coming? Now we get to total assets, which is current plus non-current, of total of 1.3 million. AP, guess what? Percent of sales. In this case, 3% of sales. Accrued liabilities, 2% of sales, getting to a total current of, oh, I'm sorry, bank loan, assume no change. We made that assumption previously in the interest expense, and we do the same here in a bank loan. Total current liabilities would then be the AP, AL, and bank loan. All right, next is common equity, which is inclusive of common stock, additional paid in capital, and retained earnings. So the change here is to take the current common equity, assume no more stock, because we don't know where we're going to get funding from, and then add to it the change in retained earnings up on this section. So in this case, it's the 237. So the total of 237 plus 800 is 1037. All right, so that's the common equity at the end. The big assumption here is right here. It's the plug. A plug is an accounting term, which means when things don't balance, you make it balance. So we had total assets of 1.3. We have total liabilities and capital here, and we need another 38,000 to balance. So we plug it. This number is the AFN. So this is how much additional capital we will need to support our forecasted sales. Right? So that's a key outcome here. Next, we want to look at our changes in the balance sheet in order to get to the statement of cash flows. This is a very simple one at this stage. Put side by side here last year's balance sheet and here the forecasting balance sheet, and simply take the change. And then what I did here was to just make a notation, whether it's a source or use. We did this in class the other day, and it's quite complicated for people to say, oh, inventory goes up, is that a source or use? Accounts payable goes up, is that a source or use? So let's go through those one by one. First, cash. Well, that is the change. It's neither a source nor a use. That's what we're solving for. Accounts receivable, it went up from 184 to 239. Since we are denied money and the receivable is going up, that is a use of cash. Inventory went up. When we buy more inventory, we're using cash. Net PP&E went up. If it goes up, we spent cash, use of cash. Accounts payable goes up. That means people are nice to us. They let us have more debt, so therefore that's a source of cash. Accrued liability goes up. We're delaying payments to other people. That's a source of cash. Bank loan, we assume no change for now, so it's a zero change, but note that it's an assumption. The common equity goes up by 237. That's a familiar number. That number represents net income minus dividends, or 237. Finally, AFN. This is the amount of money we need. This is the plug. This is how much we have to raise. So that's changes in balance sheet. Next is a statement of cash flows in a more formal way. You recall that there are three activities: operating, investing, and financing. So this does that. Income comes from the income statement. Add back depreciation comes from the income statement. Increase in receivables, changes in inventory, AP, and accrued liabilities. This whole section comes from what we just did in changes in balance sheet. Investing activity, the purchase of equipment. This is from step 3A. But notice that this, we have to do something a little bit different. We have to add our increase in net PP&E, which is 144, plus the depreciation expense of 64, which was a reduction in the asset account. So the total gross amount of purchases is 206. So that's how we get to 206. So that the gross change of PP&E was the net change plus the depreciation. And stock issued, we have no stock issued, but for now we can assume that AFN is plugged in here. Why do we assume that? Because then we don't upset the assumption about interest expense and bank loan. We could choose to have the loan or the AFN come from a loan, in which case we'd have to go back up and change our interest assumption. Not a big deal, but this is simplifying. So net change for the year is 4,800. We have 16,000 from our balance sheet beginning, and this number is a calculation of beginning plus the change and what it is at the end. And this number, 20800, should match this number here. So this is a nice tight set of assumptions that all fit together. First pass. So as mentioned along the way, we had many ways to make it improved, but as a first pass, at least we know we're in the ballpark of needing $38,000. We're saying we could just raise it by selling stock, or we may use it from increasing debt, or we may do a combination, or we can assume some other changes, right? So this is a base set on which we can operate and make further assumptions and financial planning. So learning objective 1 from chapter 9 is that forecasting sales is the number one in importance and difficulty, unfortunately. And we should be careful to do it correctly because it drives the entire financial projection. Second, we looked at sustainable growth rate and how we can use existing balance sheet and income statement relationships to forecast what growth rate we can have sales go without major changes in our capital structure. So it is kind of what is our momentum, right? So what can we do without extraordinary effort? Learning objective 3 is AFN, additional financing needed. So this is a different approach of the problem, saying, no, I don't like my SGR, I want to grow faster. The answer then is, well, if you grow faster, you need to raise money. How much money? AFN. So AFN is the amount of money you need to raise if you're growing faster than your SGR. And learning objective 4 is using the percent of sales method for financial projections. We did a rough cut pretty easily using steps 1, 2, 3 to get to income statement, balance sheet, and statement of cash flow. And we can do one pass and then go back through with successive rounds of refinement to make their assumptions better, and therefore have something we could work on or at least execute on. All right, so this is chapter 9, which is financial projections, critical, as I mentioned, for every single startup and, of course, every single company, but especially crucial for startups who need to raise money, and we need to know how much money. All right, see you in class.